Teladoc stock has been trending in popularity recently, although not necessarily for the good news, and many people are now wondering if they should sell what they have or stand on the side and wait for a better timing. Normally, I would also say that perhaps some are looking to buy more, but in this case, I'm not sure that there are a whole lot of them out there. As the market is still very volatile, we should always be mindful about which positions to pick as well as their individual exposure and timing. Over the past few days, the price action of TDOC Teladoc has brought the stock to around $29.03 as a relative low before stabilizing around the current $33.76. Teladoc was one of the stock market darlings back in the heydays of 2020. As the consumers and market participants felt the need for such a company, its stock has enjoyed historical peaks, and it was for a long time one of the most popular titles in the market. We're now in a different environment, and the stock is finding its level heading back to where it was back in 2017. Obviously, the company posting a large operating loss certainly didn't help, but just like we're going to talk about in a second, I don't believe that this reason alone can justify the current situation. We're also seeing a significant change of mentality in the way capital moves. An ever larger portion of capital participants believe that the days when you can put money into speculative stocks as a safe haven may be behind us. We're now seeing that the capital wants to feel safe and then try to earn yields when the first condition is met. This is why fixed income assets as well as crypto stablecoin stakings may be some of those possible routes. As regarding the company's own operating losses, most of it came from the impairment depreciation. On this channel, we often talk about the importance of identifying what is tangible and what is not. And in this case, we should really be mindful that an impairment of a goodwill doesn't mean that a company's operations are going sour. Nevertheless, it didn't stop the share price of Teladoc to decrease significantly. So what this tells me is that 1. Many shareholders may not be familiar with the nuance beneath the amount of profit and loss, which is quite worrisome, and this may explain why very often retail traders in volatile situations make the wrong choice. Now, let's also take a look at the technicals of the stock. The trading volume of Teladoc has recently been 34 million shares versus an average of 9 million shares. Over the previous 52-week period, its price fluctuated between $28.75 and $174.57. The market cap of Teladoc is currently at $5 billion, compared to an enterprise value of $12 billion. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or a negative image amongst market participants, the asset's value may be impaired. Now, with that being said, at the end of the day, it remains an estimation of the market every time the company publishes its data, so it's less reactive than the market cap, which is reflected on a daily basis, and it may also be arguably more lenient for many companies when the market is actually bad. This one stays the same or artificially higher. One key element to note about the enterprise value is that for many companies, one of the most significant assets they own is called goodwill. Goodwill is basically an expectation of the market that a company is able to generate more profit or grow faster because it may have a better management team, a stronger brand recognition, or simply more following online. It is basically what makes this company in particular great. In other words, it's not a tangible asset that companies may use, but is very often the reason why some companies are perceived to be trading at a discount compared to the market cap, especially in very volatile and downturn situations. If the company goes to liquidation, we're going to see a lot less of the goodwill that we currently see on the balance sheet. In fact, we're probably going to see none of it. And whatever we currently have on the financial statements are likely going to be far less after all the depreciations and all the intangibles gone. When we compare the current price to the historical price fluctuations, the stock is 17% higher than the 1-month low, 17% higher than the 12-week low, and 17% higher than the 52-week low. On the options market, which often gives us a hint on the market sentiment about where the stock price is likely going to go next, the implied volatility is 95% compared to a historical volatility of 158%. The put-call volume ratio is currently at 0.9, and it's actually normal for many companies to have a slightly higher volume of put option than what they deserve, because institutional investors very often hedge their long positions by buying put options. The most recent volume of options traded is 39,000 contracts versus the 30-day average of 16,000. Regarding the open interest, the most recent volume of open interest is 565,000 contracts versus the 30-day average of 371,000 contracts. In terms of shareholder structure, institutional shareholders own 84% of the outstanding shares. The biggest shareholders include Vanguard, ARK Innovation, and BlackRock. It is relevant to understand the shareholder composition of a company because it helps us to determine if the stock should be held long-term or to be simply traded short-term. If the stock is mainly held by retail traders, this can also be a sign that the title may lack the depth to justify long-term trust. Typically, the consensus is that there should be between 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. There's obviously a lot of exceptions to this, since many great companies are mostly held by investors who are not institutional ones, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there are significant short interest in the total volume, this is a sign that there is an organized shorting operation going on, like what is going on with GameStop and AMC. The current short interest is 16% of the total float and 55% of the transactions coming out of the dark pools. Usually, if the short interest is above 15% of the total volume and a significant chunk of it coming out of the dark pools, this can be a sign that institutional investors may be shorting the stock, and there would be potentials for a short squeeze. Now, my recommendation about Teladoc is to keep a position in your portfolio because from a fundamental perspective, it's a matter of time before consumers and patients begin asking for the services it is proposing. With that being said, we should also make sure that our exposure would allow us to hold the stock for the longer term timeframes. I would recommend between 3 to 5% of capital commitment from your portfolio in Teladoc shares, and I would also recommend to split the allocation in batches of 20% at a time so that you can purchase more if it retraces. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.